Okay, so when we're looking at trade execution, we've got to measure it against something. So this is where this idea of a reference price benchmark becomes really important. I'm a big college football fan. I did my undergraduate degree at Virginia Tech, and go Hokies. But here's the thing, I do this sometimes, and my wife has got caught on. She goes, "Hey, how was the game?" And I'll say, "Well, Virginia Tech scored 28 points. And then my wife's like, "Okay, that's great. How much did the other team score?" "Oh, 42 points. So she said they lost." Yep, they lost. So that's the whole point about reference point. When you hear, "Hey, I scored 28 points, that sounds good." When you hear the other term scored 42 points, that's not so good. So it's the same thing with trading. We have to have a relevant price benchmark to compare it to. So basically, we're going to use this reference price. It's going to enable us to also choose this optimal trading strategy. So we can come up with estimated trading cost. And with this reference prices, we can actually choose how we're going to design this portfolio trading strategy. So what are some key endpoints in the calculation of this actual trade? So for any type of evaluation, we're going to look at these reference price benchmarks. So we can use pre-trade, intra-trade, post-trade, or price target. So we have a lot of different options to choose from. So again, that's why you're going to have to agree with the portfolio manager and the trader, and you're going to have to make sure which price benchmark are you using. For the exam, I would like you to be comfortable with using these different reference prices because, again, maybe it looks great in one benchmark, but then not so great in the other. So again, that's really important to have the right reference price and the reference benchmark because everything's going to be built off that reference price. So pre-trade benchmark, the nice thing about a pre-trade benchmark, we know it before we start trading. And there are a number of things that it includes. We have a decision price, or I call it DP. So this is the price at the time the portfolio made the investment decision. This stock is trading last night. It closed at $20.30. That's where I want to go. I think this stock is worth a lot more than that. So that's my decision price. We can also look at the previous close. Sometimes, like in the case I just described, they're the same, but previous close, that's the closing price of the previous day. We can look at the opening price, so the price when the market opened, and we can also look at an arrival price, also called AP, or the price of the security when the order is sent for the market for execution. Okay, so pre-trade benchmark, these are known before the start of trading, and they include the decision price, the previous close, the opening close, and the arrival price. You'll see decision price and arrival price again. So just be comfortable with those terminology. What if we want an intraday benchmark? So these are going to be used by portfolio managers who trade passively over a day, or funds that may be rebalancing or minimizing risk. What are they going to include? You're going to have to get familiar with the term VWAP, volume weighted average price. So it's the average price of all the trades. It's weighted by their volume. So the bigger trades you can see have bigger impact on the VWAP. And basically portfolio managers can specify this VWAP to achieve the objective of using cash from sell orders basically for rebalancing purposes. So really the key thing about this, I want you to understand the term VWAP and basically be able to use that. Okay, time-weighted average price, TWAP. It's exactly like VWAP, but it ignores trading volume. Okay, this is what I'd like you to know. TWAP is most likely appropriate for portfolio managers who want to remove the impact of outliers because they are less able to participate in these extreme trades. So understand the reason for using TWAP. it's probably going to be more appropriate for getting rid of these outliers. And also, TWAP is appropriate where we have highly fluctuating volume, trading volume during the day. Okay, so again, we've talked about VWAP. Now we've talked about TWAP. Okay, now we're looking at post-trade benchmarks. Okay, so think about what the term post-trade benchmark. Guess what? It's determined after trading has been completed. So what's the most frequently used post-trade benchmark? Hey, it's the closing price. And oftentimes we want to use the closing price to execute, basically to lower tracking error of our fund. Now the biggest drawback is right here. The biggest drawback of a post-trade benchmark is that we have no idea what the closing price is going to be until it actually closes. So it is not known in advance. Therefore, I can't assess any trading performance during the trading horizon. So it's got to actually happen, and I don't know what that price is going to be. So that's a huge drawback. And then we have a price target benchmark. So this is going to be used by profit-seeking portfolio managers. They want to earn short-term alpha, and it's related to my view of what is the intrinsic value of that security. So for example, a portfolio manager thinks that there's a security, it's priced at $10, it should be priced at $10.50. So I'm going to instruct my trader to use a price target benchmark of $10.50, which I think the intrinsic value of that stock is, and I want you to pick up as many shares as possible below that $10.50. So you can see the different types of benchmarks, understand the definitions, understand why they're used and how they can be helpful. I think these are great nuggets for a couple points here or there that could pop up on the exam. So trading strategy selection, okay? So any strategy that you choose, it's got to reflect all costs and all risks, and it has to be consistent with the portfolio manager's objectives. So let's look at some common trading types and look at the most typical trading strategies or most appropriate trading strategies. So we have short-term alpha. What is the objective? I want to trade short-term mispricing. I have a high urgency. What do I want to use as a reference point? Go ahead and use that price target that's linked to the portfolio manager's estimate of fair value. And then I also want to consider arrival price when the order is placed. What execution method am I going to use? Most likely a computer algorithm. Okay, so I love these summary slides coming up. It helps you understand and select the appropriate trading strategy. As a portfolio manager, that's what you're going to most likely be held accountable for as well, unless you have a trading department. And on top of this, this is likely what you're likely going to face on the exam. They're going to ask you, here's the situation. What trading strategy makes sense? Okay, now let's look at long-term alpha. What's the objective? Well, trade over the long term due to changes in fundamental conditions. This is how I ran my fund. What is my urgency? Low. What is my reference price? I don't know. It's trading over weeks. This is really hard to get a reference price. So that means it's kind of hard to hold your traders accountable if you don't have a reference price. And what's the execution method? Hey, go ahead and sell the securities gradually over a few weeks in small parts. I want to avoid any information leakage, and I want to avoid any pressure on dealers' prices. Okay, so that's long-term alpha strategy. How about a risk rebalance? What's the objective? Rebalance the portfolio. Urgency, it's low. Because I'm both buying and selling, that lowers my execution risk. Make sure you're aware of that. What's the best reference price? In this point, it's the TWAP. And what execution method am I going to use? Some type of algo TWAP target, and maybe set it up over the next couple of days. Okay, what about a client redemption, a cash flow driven client redemption? Well, the objective, I'm going to have to liquidate some holdings if I don't have the available cash. When is the urgency? It's got to be done by the end of the trading day. What reference price am I going to use? This one is easy. We're going to use the closing price. That would be what I would go to as well. What execution method am I going to use? Well, go ahead and execute a reasonable amount of liquidity in the closing auction. So evaluate the rest maybe at VWAP. But again, we want to look at the closing price here. Now, what if I have a new trade mandate? This one's a little bit tricky. So let's say we have an objective, invest a new client fund, or invest this large amount with a mandate to track a small cap index with a 3% tracking error. And performance measurement will begin at the current day's closing price. So what's the urgency? Well, liquidity is too low to execute in the underlying security, but I have to get immediate exposure. So what can I do? Use liquid index futures. And what reference price am I going to use? I'll use the closing price. What execution method am I going to use? I can get immediate exposure by using that index futures. Why am I doing this? I can eliminate cash drag. And remember, I had tracking error risk that I had to deal with. And what are you going to do? Well, over time, you'll sell off some of that future and you'll buy the underlying stock. What's great about this? You reduce market impact while at the same time you're unwinding that futures position. So you're getting the exposure, you're meeting the tracking error that you have to, you're getting invested, but you're doing it in a way that minimizes market impact. Okay, continuing on to the new trade mandate. There are actually two issues with this method. So the first one, there may not be a closing auction for the futures contract. If that's the case, well, then try to trade as close to the market close as possible. The second issue, this is the most important. The client's IPS has to allow for derivatives positions. You have a major problem with suitability if this isn't the case. So before you try this strategy that we went over, I need you to make sure that they're allowed to trade derivatives positions. Because yes, this is a great strategy, but if they can't trade derivatives, they can't use futures. Okay, so as we went through this section, what I want you to walk away from, yes, it seems like there's a lot of minutia and we're going into a lot of terms and definitions, and we're going to be doing that a lot in the trading section. But don't lose track. The idea is you've now decided to invest a portfolio. Now, how are you going to trade it? And this idea about having a reference point, like I said in the beginning, if you're playing a football game and you say, we score 42 points, well, did you win or not? I don't know, unless you tell me what the other team scored. It's the same thing here. I can't evaluate you if I don't have the proper benchmark. And again, we're trying to really justify and take responsibility. If the trader messed up, the trader messed up. If I messed up, I messed up, okay, or the portfolio manager. So that's why having an appropriate benchmark and evaluating these trading strategies and the evaluation of the trading methods are so critical. We're going to talk about this a lot going forward in the trading section.